Right. Good morning and welcome everyone to the very first, nay, the inaugural Mortgage News Live, coming to you from various freezing areas across the UK. First of all, I would like to say a big thank you to our sponsors, MPowered, the Intermediary, and of course, Newspage and the brains behind all this, Mr. Dominic Hyatt. We do have a packed agenda this morning, and the year really has got off to a flying start with a plethora of rate cuts, followed by some more rate cuts. And just as you can't bear to have to rebroke another case for the umpteenth time, yes, you guessed it, more come along. The latest have been NatWest, HSBC and Metro Bank, and we now have a smattering of products below the 4% level. Most brokers I've spoken to have seen a definite uptick in inquiry levels, but are they translating into actual mortgage business and increased demand for property? All eyes will, of course, be on the latest inflation figures and subsequent swap rates, but how do lenders price in this market? And can we expect to see rates drop much further anytime soon? And what does this all mean for property prices? Have we now reached their nadir, and the perennial property doom mongers, are they going to look like right Charlies? Or do they actually have further to go as employment starts to weaken and the economy starts to wane further? All of these questions and many more will be discussed with our lovely panel this morning. First off, delighted to have Peter Stimson. Welcome, Peter.
Morning.
Peter has been in the industry for more years than he cares to remember. Starting off working for building societies, Peter ended up in the early 2000s as head of product at GMAC before going on to be head of mortgage products at Lehman Brothers. Since this time, Peter has since worked at CoreLogic before running Quest UK in a brief sojourn away from pure mortgage lending. He has now returned to the dark side, joining fintech mortgage startup MPowered Mortgages in late 2019 as head of mortgage products and pricing. And away from work, Peter also says he has a keen interest in sport and a questionable taste in music, which maybe we'll come on to later. Also delighted to have the lovely Emma Jones, who's MD of When the Bank Says No mortgage advisory firm.
Morning.
They're on a mission to change the way clients receive advice in the UK mortgage market. Emma, welcome. And
Morning.
I know that you have your team's passion for helping people overcome the challenges they may face when applying for a mortgage, which has fueled the success of When the Bank Says No. And you're an award winner now, I believe.
We are. Yes,
we are. Very good. Very good.
Thank you.
And finally, last and least, you may say, we have star of stage and screen, Riz Malik, who is director of R3 Mortgages, a mortgage broker turned IFA, and in his own words, a breaker of hearts since 1980. So, welcome, Riz. Delighted to have you all here. So let's actually start off by looking at the key developments of the year so far. So I mentioned there has been loads of rate pulls and increasing levels of interest and inquiries, but Emma, if I can come to you first, has this actually led to more business? And what do you see actually happening on the front line?
So last year, we finished in December being one of our second highest months of new business.
Right.
So obviously we work in a different space than most of the prime brokers out there because we're dealing with a lot of more complex income, complex credit. But December was one of our record months in terms of new business. We've come back into the new year and we've not lifted our heads up once because we are busy. And I feel that we're some of the luckier brokers that aren't battling rate wars at the moment and being pretty much busy fools. So yeah, we are still seeing business coming in.
That's good. Riz, what about you?
We've seen an uptick in purchase inquiries, which is definitely very welcome considering 2023. We've still got a decent book of people who are renewing between now and June that we are working our way through, and also with the revised pricing, seeing if what we've talked to them about before is still the best option for them. But I'm very optimistic about 2024. Monty, I think it's going to be a year that's going to make up for last year, and with rates and where swaps are at the moment, I think there's a nice bit of calm that we haven't seen for quite a long period of time.
Yeah.
Famous last words.
You heard it here first. And Peter, what about you? Are you seeing an actual uptick in applications of yet? Are those customers actually coming through?
I think it's very strange from a lender perspective, because we've kind of seen an absolute mad start to 2024. I mean, we had Halifax launch products on New Year's Day. I mean, normally you wouldn't get lenders kind of bothering launching anything till, you know, the 16th or sort of 18th of January. I mean, part of that was to do with where the swap rates were going, but you've just had lenders just launching, you know, rate after rate after rate so far this year, and you know we're still not at the 16th. You know, we've changed products 3 times this year already. I think from a lender's perspective, unless you're, you know, literally at the top of the market, you're not really seeing any volume, which is, you know, I know you have to be kind of at or near the top to kind of get decent volumes, but it's changed from that perspective. So we're seeing volume, but it's very, very, very price sensitive. And I think from a consumer side or from a broker side, there was a real rate war going on out there at the moment. And we're seeing prices, you know, as competitive as they've been since 2007 from a lender perspective. So, you know, it's great from a broker side and great from a consumer side. Probably not so great from a lender side, but, you know, don't quite get your violins out yet, I say.
Well, talking of the world's smallest violin, I was going to go on to the fact that swap rates are going up and down. And, you know, there are so many global issues now, trouble in the Red Sea region that could transmute into higher prices and higher inflation. And a lot of lenders have been telling me that their margins are very thin at the moment. But it would be good to know from you, Peter, what does actually influence pricing? What are the variables? Is it inflation, base rate, gilt yields, macro forecasts, etc.? And why do lenders sometimes have to pull rates with very little notice? What's behind it all?
It's generally driven by the swap rate. So basically, it's driven by how much funding a lender takes out and the movement in the swap rates. So, I mean, the last 22 months have been very chaotic from a lender, and it's partly driven by the position lenders came from. So if you think the period from sort of 2010 to sort of the early part of 2021, rates simply didn't move. You know, if you were working in a treasury department, you know, and you wanted to top up your funding, you know, the position on a 2-year tranche or a 5-year tranche simply didn't move. So you wanted another 50 million of funding or 20 million of funding. You simply go along, and the swap rate had moved 2 basis points or 1 basis point. So you go and top up a position, and you know the price could pretty much stay where it was. Then you know the rates started moving up, you know, fairly quickly in sort of early 2021. Then obviously we had Liz and Quasi for that little experimental period of 44 days.
We got rid of him.
Yeah, well done, Riz.
Riz, didn't you? Well done. And then it's complete chaos, and you're going back and you're trying to top up a tranche, and the swap rates move 20, 30, 40 basis points, sometimes in a matter of hours. And obviously, you know, you've got probably a wafer-thin margin on that product of 5 or 10 basis points, if that. And obviously, suddenly all your profitability is gone. You're having to pull a product. The other problem you've got as a funder, as a lender, obviously, is you know, you might be number 5 in the market and anticipating, you know, 10, 20, 30 applications a day. You suddenly go from number 5 to number 1 in a matter of hours. You're suddenly getting that number in a matter of minutes. So whatever funding you thought you had has just disappeared. So, you know, you simply can't, you know, run the funding for that level of period of time. So it's kind of a combination of, you know, the position on your funding changing so quickly, plus the anticipated run rates just disappearing. So, you know, it's perfect storms developing for lenders, plus, you know, not being in that position for such a long period of time.
So for you guys, do you think it's the hardest market you've seen since the credit crisis? Because I said last year that I felt for a broker it was the most stressful market since that period. Are you seeing that from a lending perspective as well?
It's incredibly challenging when you've got the volatility going on, and volatility works both ways. It's very difficult to price when rates are going up, and it's equally very difficult to price when rates are going down, because obviously your hedging gets cancelled on the way down as well. So basically, someone takes a rate out at 5%, for example. Then what's happening is, as the rates are going down, the customer quite rightly is obviously switching as the rates before completion, as the rates go down. You're having to cancel the hedging as the customer switches on the way down as well. So it's very difficult, again, from a lender perspective, to price and to hedge. So that's equally as challenging, because you don't know at the point the customer completes what actual hedging you need to have in place. So it's very difficult to kind of work out what position you've got to hedge and what fixed rate money you need to account for. So yeah, it's challenging both ways. So it's kind of, stability is kind of what you really want, but obviously lower rates is kind of what the customer wants as well. We get that.
Yeah. And how many people have you got involved in your decision making process? We're
pretty good. So from a decision making process, you want as few as possible, because you want to be able to get rates out quickly.
Yeah.
So we're very light touch. We've got less than half a dozen, so we can get rates out very quickly, and equally we can make a decision to change stuff very quickly. Some of the bigger lenders will have a much longer chain.
Monty, can I ask Peter a question?
Yeah, of course. Go on, Riz.
So, Peter, we were having this conversation before. So we're coming in, we're seeing lenders reprice downwards, and I'm not just specifically talking about yourself as lenders. I'm talking about the industry. So I appreciate that, obviously, if rates are coming down and people are coming down, then there's a cost to lenders if people switch from a deal that they've offered on, or there's one deal going to a lower one. From us as brokers, our number one, we're instructed by the clients, we're acting for them, we need to do what's good for them. Where do we find this happy medium of lenders being able to cope with us telling them we need to make that process as easy as possible in terms of repricing, especially in a falling market, versus lenders being able to cope with it, or it causing them either service issues or financial issues with hedging? Can you explain that to me a bit? Where do we find the equilibrium?
Lenders should every lender should be allowing you to do a switch. There should be no issue with doing a switch. So I can't think of any lender that doesn't allow you to do a switch. So it should be a fairly straightforward, easy process with every lender. So from our perspective, it's just simply the broker just dropping us an email in saying, this is the new product I want. Can you please switch my client to the new 2-year fixed rate at 4.54, whatever it happens to be. So that should be the process as far as we're concerned. A nice, straightforward, easy process. Select the new product you want, subject to there not being a change in a loan requirement or anything like that. Should be straightforward as that, really.
How has the mortgage charter had an effect on you guys and lenders generals? It's something that you subscribe to. Yeah,
we subscribe to the mortgage charter. Yeah. So yeah, there's no debate about switching a customer from our perspective. If a customer wants a lower rate, it's a straightforward process.
I think it's been quite interesting that we've seen a couple of lenders. It seems that they've waited until a swathe of customers have completed on their PTs before coming out with lower rates, which has caused a lot of brokers and a lot of clients concern the day after, when I'm sure we've all had some angry calls from clients because of that. Do you put that down to managing that tranche of funds so that they don't have to keep rechanging those products?
I think it's interesting, without wishing to name names, I think it's interesting about the timing of some lenders' product offerings. So every lender brings products out at different points in time. The challenge from a lender's perspective is obviously lenders, every time you produce a new product range, there's the fact that customers will switch and the rates are lower. You get a swathe of customers switching to the new lower rates, and you accept that as a lender. You know the fact that you're going to get new business coming in and the existing business will switch to new lower rates. You do see with some lenders, particularly when they've taken a lot of business on at cheap rates, sometimes you'll get a delay between them bringing new products out and the new products pulling through on the pipeline. So there is sometimes a game that some lenders play between products being launched and products then the next range coming out and waiting for the customers and the products to pull through. So there is sometimes that delay that happens.
Peter, do you think we will see a lender who comes out and automatically reprices downwards if you do have an offering?
Oh, I don't know.
There was a good a LinkedIn someone on LinkedIn has just commented on, in the Australian banking market, decreased rates are automatically applied, reducing the broker and lender workload. So yeah, I think, do you reckon a lender could do that?
I think
go on.
Can I jump in? So if you're pricing your products, I don't say, I'm with Riz, I'm a broker on the front line, had enough of re-quoting clients, going back and doing more work. As I'm sure a lot of brokers will feel the pain. But if you're pricing products, why can't the lender price in the existing clients due to mature and the clients that are due to mature in the next 6 months, and then just automatically pass that saving on to those? That's just me from a broker at the front line and thinking, wouldn't it be easy that everybody knew where they stood and the clients just took advantage of the rate reductions when it happens?
I think there's a challenge sometimes when a client switches rate, asks for a rate reduction, they don't always switch to the same product they're actually on. So I think there's sometimes you have to think about, we get requests in. So clients, for example, on an existing 2-year fixed rate, we get a rate reduction request, they don't actually always switch to the same product. So there's first of all that issue. So we have to consider that. So, we're not the person giving the advice. So sometimes we bring out, for example, we have a good range of 3-year fixes as well as 2-year fixes. Sometimes the rate on the 3-year fix can drop below the 2-year fix, believe it or not. So there's kind of a very tight pricing, and the 3-year swap is actually lower than the 2-year swap. So you've got obviously an inverse yield curve at the moment on the pricing. So sometimes we get a situation that, we drop our pricing and the 3-year goes below the 2-year. We get customers saying, actually, you've dropped your rates. Actually, my client wants to switch from the 2-year to the 3-year. So there's
ultimately, that's change of advice, though, isn't it, for the broker? I think the point that I know me and some of the other brokers are probably making between ourselves at the minute is that if we're offering a 2-year fixed product with a 9995 fee, and that rate reduces at that product range, that savings should be passed on to the client. We appreciate that. When the term of product that we're recommending changes, we've got to change our advice. We've got to change our suitability letters, all the rest of it. But I think there's a space there where we're doing a lot of work that is wasting a lot of time, and obviously it's costing the lenders money every time that new PT application goes in.
Which comes down to the fundamental question, Emma, that we all ask is, how much should we be charging? And what should broker fees look like? Especially for PTs. If you're switching people a number of times on a PT, how much should we be charging?
What do you charge, Riz, on a PT?
Not enough, as I should do. I think this is very topical. Just digressing slightly, we were discussing about this before, and I think with the amount of work, especially in a falling market that we're seeing potentially, if it does continue, that these are things that we as brokers running our own businesses need to factor in. And I appreciate that, obviously, Peter, from a lender's point of view, there's an administration cost and there's other costs associated when that does happen. But then conversely, I think even if somebody paid a £99 fee for switching and after an offer's been done or something like that, I don't think too many people would be adverse to that type of thing. What do you think, Emma?
Yeah, I think some of the older building societies still do that, don't they? I think they still charge a fee when you want to change a product. But if the client's saving money, then why not? If it helps balance, then that gets us to a happy medium, doesn't it? Ultimately,
it'd be interesting to know what the brokers think in the comments.
Yeah, I was just about to say, actually, in the comments section, we're getting some good comments through. If you do have any specific questions you want us to cover off, then do put them in the comments section.
Has Riz put the question out to everybody watching about what they charge for PT?
I think he's talked about it ad nauseum, basically. Just on the subject of PTs, actually, Riz and Emma. So obviously, that we know as brokers that we're doing so much more work on these cases, and how do we get our message across better that lenders should be supporting brokers and increasing prop fees on PTs? Riz, go on.
I think that's a great question, Monty. And from the lender's point of view, I can understand their argument, especially if they're offering retention rates and the margins are thin. But if you look at the volume and the amount of business that brokers do transact, I think that does need to be. A PT is going to take just as much as work as a standard remortgage, especially from a compliance point of view. So I think halving potentially what you're earning. I know not all lenders do that, but I think that's really had an impact on a lot of us in 2023, and I'm sure a lot of other brokers will agree.
I think we just need to pull more calls together like this and bring Peter's equivalent on for every lender and challenge them on it.
Yeah, I mean, it's something lenders could certainly look at, because I mean, I think there's probably an assumption within lenders generally that the PTs are less work, and if PTs aren't less work, the fee can be upped. And I think a lot of PTs are priced sometimes below the rate that a remortgage rate is priced at, simply because the economics are viewed as better from a lender's perspective, because they're paying less for it. The customer's viewed as the probability of default's viewed as less because they're an existing customer, etc., etc. So there's the economics to potentially look at that.
But Peter, where do we stand on the price differentials with lenders charging different amounts, whether it is a new purchase, whether it's a remo, whether there's this personalized pricing going on? I would just love to see an element of transparency of a lender setting their pricing and seeing it. Why have we got lenders pitching at certain levels so differently from what they're offering some of their existing clients?
It gets complicated when you're looking at that. So you're talking about the different pricing on a purchase, on a remortgage, on a PT?
Yeah, purchase
exactly.
versus remo versus PT. Back book versus front end.
Okay, so it all comes down to how much volume they want in different areas, the mix of the book. On a PT, it will come down to the fees they're paying out, for example. So if they're paying out less fees on a remortgage versus a PT, it'll come down to the processing costs. So on a PT, there's less processing costs, for example, because they've already have the business. It'll come down to the perceived probability of default on a PT, because obviously on a PT, they'll already have the business. So the case would have been performing for 2 or 5 years, for example. So they'll know the client, they'll know the likelihood of PD. So be things like that. The LTV might be lower, because again, they may have had the customer for 3 or 5 years, so the LTV might have dropped.
But couldn't you argue that with credit files, you already know the perceived background of somebody as well? So couldn't it be argued that 100 grand lent out at X, it shouldn't make that much difference? Or am I just putting this in a very simplistic way?
It might come down to risk-weighted adjustments under different categories, under various things. So
ultimately, the types of clients that we're dealing with, if the capital raising sometimes and they've had adverse events after it, it makes sense for them to PT with their existing lender. And ultimately, the lender has no idea of what that risk profile is, because they're not credit scoring the client. We've got clients that have gone into active debt management plans, IVAs, things like that. And the best advice sometimes is to PT, because why would we move you to a complex lender for the whole debt when we can move part of it? So obviously that's another argument towards the pricing, that the lenders actually don't always know what the risk is after that client took a mortgage out with them 5 years ago, say. Just from what we see anyway.
Yeah, no, that's really interesting, Emma. I think actually this year will be quite interesting, because I think it will be more of a remortgage market than a PT market. So we will see remortgages come back, which is good for all of us.
And you think about on a remortgage as well, a lender is obviously having to pay a lot more fees to get a remortgage in. They're often paying legal assist. They're often paying a little bit of a cash back. There's often a val fee as well. So you think they've often got upfront fees, probably pushing sort of £500-600 at least on that case.
Okay, thank you. I think I'm going to leave this particular subject. Peter, you're off the hot seat on that. So you can relax now. Yeah, cool. So we've got the inflation report coming out soon. We've seen wage growth, which is equally as important. That's really key. That needs to cool. But if CPI comes in better than expected, do you think we'll see another surge in the rate war? Do you think we'll possibly see sub 4% 2-year fixes? And also conversely, what if it disappoints? Where do you think bank base rate is going to go this year? Who wants to kick us off on that one? Riz, go on.
You know, I'm itching to answer this question. All right, okay. So with the inflation print coming out, and also with wage growth cooling, the Bank of England, I think, want to see two things. They want to see inflation coming down towards 2%, and they also want to see wage growth cooling. Today, we've had wage growth cooling, but as well as all of these factors, which are all suggesting that pricing is on a downward trend, and before anybody kicks off, nobody nowhere knows what tomorrow is going to bring. So this is just based on what we're seeing at the moment. I think that the biggest threat to where we are at the moment in our pricing is the geopolitical risk, and you can just evidence that by the CEO of Lloyd's Banking Group is in Davos at the World Economic Forum, and he's been talking to Bloomberg, and he said, and just quoting Bloomberg here, the UK economy looks good at the moment, but the challenge is the uncertain geopolitical landscape, and I think that could cause an issue here. If we've got conflict in the Middle East, we could see an increase in oil prices. That's straight away going to feed into us having a problem. And then conversely, there is other inflationary factors here, which could start seeing us tip slightly the other way. And it's not even just about that. Sometimes the biggest problem is not falling quick enough for analysts' expectations. We know how that can feed into the pricing. So one thing that we've all been discussing, and I've been talking about, is hedging. And we need to communicate with clients. If things go down, great, but tomorrow they could turn very quickly. So I think we need to tell people and make sure that they don't just think that tomorrow lower rates are guaranteed.
Making real-time decisions, because we know where that was at the budget when that happened, and the conversation's not the best when you're telling a client that your rates gone up and your payments have basically gone up more than what your council tax and everything else is.
Peter, what are your economists telling you? What's your MPowered prediction for where rates are going?
We kind of think it's kind of been priced into the swap curve already by and large. So, you know, Bank of England base is 5.25. The 2-year swap kind of bouncing around somewhere between 4 and 4.20 over the last sort of month or so. So, you know, you've kind of got 3 rate cuts priced in over the next 12 months. So I agree with sort of Riz. There's a lot of kind of uncertainty over the next 12 months about kind of the timing and the extent, because of, you know, the Houthis lobbing, rockets at the ships, et cetera, and, what's going on in Ukraine, and, does Donald get put in prison and end up as president of the USA, et cetera, and all kind of good things like that. But, we kind of think there's a downward trajectory, definitely. The extent and the timing of it is just to be decided, really. So our best bet is there's probably a cut in March. There's probably another cut kind of June time if I was a betting man, but I wouldn't put too much money on it, to be honest. And, we'll probably end up round about 4.5, 4.25 by this time next year as a wild guess. But I wouldn't put too much money on it. But, the timing and the extent is uncertain, to be honest. And also it depends what the Americans do. America sneezes, we catch a cold. So watch the Fed.
Yeah.
But Peter, if we're looking at 2-year swaps now, just above 4% or something, we keep on asking, when will we see this 2-year fixed rate under 4%? By the time the lenders obviously price their margin on, something still is going to have to happen before we're in that type of territory, isn't it?
What do you mean in terms of to get down below 4, you mean?
Getting 2-year money down below 4%.
Yeah, I don't see 2-year money below 4% in the short term.
I agree with you.
Yeah.
Yeah.
Ultimately, what Riz is saying is about advising the clients now, isn't it? I think we can talk about all the variables that are going to impact the rate pricing, but if we're not, advising the client right now and giving them that confidence to make a decision right now rather than leave it, we're potentially putting the client at risk, because there are that many variables right now. So I think I agree with you on that, Riz, in terms of advising the clients to try and make a decision now, because it is difficult. Because you see the rates coming down in the press and they think, oh, another week, it might be even lower, and we might see
Yeah.
that 4%. But
And that's sort of the
But now-
hardest thing at the moment, isn't it, in terms of how are you advising your clients? Because they all think, oh, let's wait. Rates are going down. Property prices, will come onto that in a minute. They're going down, so I should wait. But how are you advising clients now? It is, for me, I agree with you. It's about there's never a good time to buy. There's never a bad time to buy. It's about doing what's right for you and affordable for you at this moment in time. But how are you getting that across to clients at the moment?
It's the decisions that the advice that I can give you is based on today, is a conversation that we have. And ultimately it can take, this is something the lenders probably don't like, is us changing the rates. But we are having to lean on that. If we do give you a recommendation today and the rates do come down, we will revisit it as part of the broker fee that we're charging you. I don't know if you guys do the same with in your firms, but
yeah,
in terms of how we position it.
I think there is still the expectation that the client talks to us and we just press a button and an offer comes out at the other end. And I think it's more down to us now, more than ever, saying to people, look, we've had 2023, that's over, but we have to revisit this case a number of times. There is a cost associated to that. And coming back to how much do you charge for PTs and this, that, and the other, although we jest, I think, again, we need to remember that we are businesses at the end of the day and we are selling time. And I don't think any client's going to have an issue with that if at the end of the day they can pass over that responsibility to somebody else and know that they don't have to get involved or worried. But that's a thing. I think part of this whole process is a re-educating of what's involved in the mortgage market, and that as brokers, what we actually do, it's not just about pushing a button and getting a piece of paper at the end of it. It's that continuous monitoring thereafter. And I think a lot of people don't know that, but I think it's because we probably don't do as a community enough to inform people that that's what's happening.
I totally agree with that, Riz, and I've said that for a while. I think as a broker community, we are excellent. We look after clients really well. We go above and beyond, but we haven't really been that great about shouting it. And if you stop 10 people on the street and ask them what a mortgage broker is and what they do, not many of them will probably know. And that's one of the ethoses, I guess, behind Newspage and getting more voices out there. Getting more professional people who are actually doing the day job day in, day out, and actually explaining to the public what we do.
But Monty, what about lenders trying to contact the clients directly and tell them you can do this or you can switch 6 months early and this, that, and the other? And then going back to our previous conversation, if the clients do that and the rates do come down, are they going to be told that the rates have come down? And where we're looking at swings of 10 to 15 basis points, it is better to switch, but it's not going to do it. We're looking at some hefty swings here, especially coming out of the blocks the first 2 weeks. And our clients' affordability is key, regardless of whether you're earning 20 grand, 50 grand, 100 grand, 150 grand. If we can put more money in their pocket, that's our job, isn't it, at the end of the day?
Yeah, absolutely. And we've actually got back some clients who have gone direct because they weren't told about cheaper options, even with the lender that they've gone with. So it's worth keeping in contact with all those clients you lose direct to the lender on that point. Emma, just interesting in your business, because I know you do a lot more specialist stuff. You mentioned to me that around about 40% of your business was on an adverse complex basis. What do you see your clients asking for at the moment? Are there areas that are underserved, and are you seeing a rise actually in people with credit issues because of the whole
I think there's more and more clients that we see that have been impacted around COVID, following from COVID, that have historically always paid the bills on time. And obviously coming out of COVID, there's been job changes, things like that. And then they've then got some stability back, and then they've been hit with the cost of living. So we are seeing an increase in blips, should we say, from clients coming to us, but more within the last couple of years. So there's nothing else before that for a lot of them. So I'd say at least 30% of the people that we see aren't repeat offenders. There's literally been hit by COVID and cost of living. But the rate wars, one of the things that I was talking about sort of earlier, was the rate wars don't impact us as much because we're not a volume prime broker. However, we have seen pepper reduce. You know, we've seen pepper 48. I think that was starting at 5.8 recently, which is massive for us in the complex space. But that competitive rate war isn't always there. We have got specialist lenders as well. If the rates reduce, we have to resubmit the application. So the client has that conversation with a broker. You know, we've then got to say to them, look, there might be a 0.5% decrease, but the risk is that we've got to go through that underwriting, and it might have took you 2 months to get that offer. So we're not as impacted as the likes of Riz with the PT rate changes and things like that. But definitely seen a rise in adverse.
It'd be interesting to know in the chat, if we were having this conversation before, if people, other brokers are seeing more cases where people have had credit blips, or they are seeing more adverse starting to come through. Because obviously Emma was talking about her experience. It'd be interesting to know what other brokers think and seeing at the moment as well.
Have you seen it, Riz, in yours? Because actually, to be fair, we haven't that much in our business, but then we're not really in that market.
I can't say I have.
We're
Emma,
in the space, aren't we? No, we're in the space, aren't we? So the types of clients that we're getting, but all we can look at is their adverse history. So the adverse, a lot of it is 19 onwards. But I don't know if that's just because of the types of clients that we get.
Emma,
we're definitely not a vanilla broker. So
I think the no in your sign's fallen down behind you, Emma.
No.
No, Monty, we haven't seen it. Pre 2023, the majority of my business was portfolio buy to let. And obviously that's where our issue has been, especially over last year. We are starting to see some landlords come out and starting to have more conversations going forward. But in terms of adverse, we'll see the odd blip here and there. We deal with quite a few doctors, and we see a lot of CCJs for doctors due to parking, surprisingly or not, when they've been at the hospital over an allotted time and they come. But it's usually a few £100. But no, we're not in that same space as Emma.
Just definitely different space, but just to challenge you on that, limited company though, a lot of adverse is ignored. Buy to lets.
Very interesting. Good point, Emma. Peter, have you seen the nature of your clients change at all? Or are you very structured? This is what we want. This is what we will always have.
We've seen, I mean, as the rates have risen, we've seen, affordability is the main thing. Just increased strain on affordability is just the main thing we've noticed over the last kind of 2 years. I mean, we've only been going, for 2 years. So we've kind of been going in a stressed environment, basically. But we've noticed as the rates have been going up, just stress on affordability and just kind of increased challenges around that, to be honest with you. That's been the big thing.
Okay. In the last 10 minutes, I want to talk about, there's just a couple more things, but I want to talk about house prices because there are some very outspoken people across the social media sphere who do think that house prices are going to drop about 1,000,000%, etc. So with rates coming down, just have we seen house prices bottom out now, or actually is there further to go? And is it still a buyer's market, or is the balance of power going to start shifting back to sellers? What you're all seeing on the ground, and how are you expecting to see 2024 to shape up on the house price front? Peter, if I can come to you first around what you think internally house prices are going to do. Are you quite confident?
I think they're holding up pretty well. I'm actually trying to move at the moment, so I'm going through the process. So
right,
it's quite a localized issue, is what I'm finding. So I think there's still a shortage of supply. I think supply is still in limited.
Absolutely.
Which I think is holding stuff up. So there's not been, the panicked sellers coming onto the market, which everyone seems to think there would be. I think there's been a small amount of, buy-to-let sellers coming onto the market, in particular, sort of, the 1-2 bedroom flats coming on, which has maybe pushed prices down in certain sectors of the market. But I think overall prices have held up really well, and I don't see any reason why they're probably not going to hold up fairly strongly for next year. I think the only thing people don't really take into account when they look at prices is inflation. So we've had inflation kind of running at, 8, 9, 10%. So although prices have kind of gone down sort of 1%, 2% last year, depending on what, survey you look at, whether you read, Halifax, Rightmove, nationwide, whatever, prices relative to wage inflation or whatever have gone down from a buyer's perspective, but I think they're probably going to hold up fairly well this year. They maybe nudge down slightly, but I don't see the crash, to be honest.
No. Riz, what your thoughts? 30% drop?
No. Monty, we've got the. I think if we remember, cast our eye to last January, we thought that things were going to start improving straight out of the bat, but it took towards the end of Jan, early Feb for the market to really start moving.
Yeah.
And I think that these rates are going to start bringing people back into the. If you imagine if you try to sell a house in 2023. Just imagine the pain that you've had to go through. And I think people will be reassured by the rates that we're seeing. Monty, we've got budget in a few weeks. If the inflation print, which I think is tomorrow, comes out and all the data suggests that maybe things aren't going to go back to where we were in September of 2022. I think also the fact that we've got, although we're apolitical, we've got an election hopefully at some point this year, second half. I think there's going to be a lot of momentum that's coming out. I do think, though, the longer people leave it, if we are in a falling interest rate environment, this window of opportunity that the first-time buyers have had is going to be eroded, because I do see the buy-to-let landlords coming back in at some point, because don't just assume that everybody's lost money. There's people sitting on a lot of cash at the moment, and I'm sure you'll attest to this, ready to move once they feel that there's a bit more confidence. So I think I don't think I'd be very surprised if there was a fall. I think we'll see a steady and slight increase from this year, but the 30% that were quoted last year, no way, nowhere near that.
Yeah. Someone's mentioned it's only from the valuers you're seeing a big fall. Emma, what are you seeing? What are your clients telling you?
So for the course of 2023, I never ever said 30% drop. I'm just putting it out there.
Not many did.
Not many did, no. But I was definitely one that said stabilising market, stabilising. We have, as a firm, I can only talk about my firm. We have seen an increase in buying from landlords. Normally the value of the property would decrease because the demand for buying property would reduce. But I think rents have gone up because obviously mortgage rates have gone up for landlords as well. But I'm with sort of the rest of you guys. I think it'll stable. It would be a percentage difference, but it's definitely time to buy, as it always is. Time to buy.
Yeah, I do agree with that. I do think 2024, you could look back in 3, 4, 5 years' time and think actually 2024 was a really good year to buy. As house prices are soft at the moment, I think once demand does come back with any great force, which it looks like it could well do this year, I think you'll see those towards the end of the year, house prices start to tick up again.
I think there's going to be some sweeteners in the budget. Sorry, I think there'll be some sweeteners in the budget that will come out, because no one's going to win any elections unless the feel-good factor returns, and the biggest way to get people feeling the feel-good factor is in terms of their house prices and the values that their houses are and how the housing market's looking. No one's going to win an election with things as they are. So I really think that in the budget there's going to be some sweeteners to get things moving. Anything
in particular you think that they can do? Because it's pretty hard now for them to do anything, because A, they've got no cash, and B, what else can they actually do in terms of stamp duty or
SDLT holiday? It's going to be, I completely agree with the SDLT holiday, quickest way to do it. Again, it gives people another reason to take action, and if they're not getting massive revenues from 2023, it's not really like they're losing anything. And we need that to kickstart the economy going forward. We haven't even mentioned the house builders at the moment. Obviously, they haven't had the greatest of years last year necessarily. So we need something to kickstart things as well as rates. And I think an SDLT holiday will be the quickest win.
Peter, do you agree with that?
Yeah, I think stamp duty holiday and the lack of revenue probably won't be this government's problem either. So
yeah, they're definitely storing up issues for potential government of another colour. Yeah, absolutely.
Yeah. So.
Just just before we end, just really interesting, obviously, Labour, talking about Labour, actually, they're the latest to come out with things around long-term fixed rates. Fixed rate mortgages are going to be that's going to change everything. We've seen the likes of Perenna, and we're soon going to see April mortgages come into this space. Do you think they'll ever work and make a difference? Emma, what do you think on that front?
There's just so many variables, isn't there? I mean, the first time buyers moving to larger properties and things like that. I think there's a space for it. There is a space for it in the market. Do I think it'd take over? Probably not. Just the way that the UK property market moves. You've got your first time buyers buying the terrace, then they move up to a detached. Job changes. There's a lot of people that we speak to, first time buyers, are on a career pathway. If they're tied in, if they're tied in for a 30-year mortgage, that's going to limit the plans that they may have, to have a family, move to a larger property, things like that. But there is a space for it, but I don't think it'll take over the market.
And the difference with these ones is they're trying to just say there's only penalties within the first 5 years, or you can have if for certain changes in lifestyle. Peter, is it ever anything that you would be able to fund or consider?
Yeah, they're an interesting product, and we're looking at them. I think they're the right product for the right client. So I don't think it's a panacea for the whole market or for everybody. I think they're kind of challenging it when the interest rates kind of fluctuating up and down, because I think you could take a product out and the interest rate moves very quickly, and you suddenly find you've taken a product out at the wrong price. I think the pricing of them has got to be kind of within a certain position within the 5 year, because obviously if if they've got 5 year break point, you've got to position them within a certain price point of a 5 year fixed. So you're not selling it against the 5 year, you've got to position the price within a certain position of the 5 year as well. So the rate is fairly key as well. So I think that's fairly key on them. And again, I think so Emma's making the point, I think you've got to be at the right stage in your life when you take these things out, about not looking to move within X period of time. So I think it's a product that has a particular niche, and I think they will work particularly well for certain clients at certain stages in their life.
One of the keys is that they mention about this is the ability to lend more in terms of income multiples. Do you think that's gonna help, or do you see dangers in that?
Monty, if we were going to have a question about having 30-year deals, this should have all been done pre-September 2022, and in that very long period after the credit crunch that we had of low interest rates. We've come to a spike, and now we're all of a sudden talking about doing it, and it's one of those questions. And are you fixing too high? Where are you fixing? Are you fixing at the wrong rate? This is very much an American concept, which works fantastically over for them. But the shift in mentality would be the greatest thing that I think you'd have the opposition from people over here, unless it's going to lead to a big increase in affordability. But the other thing, Monty, that could equally help potentially with affordability is by improving the amount and the whole interest only proposition. I've never understood why we're okay for people to rent for the whole of their lives, but taking an element of their mortgage on an interest only basis, especially when they're on a certain career trajectory, the regulators can't take a more sympathetic view towards that. So I think that's more of an answer, as opposed to locking everybody into high fixed rates, especially if rates coming down, if they do come down.
Very interesting. So I think we're almost out of time. So I'm going to say to each of you, have you got any last words of wisdom to all the brokers watching and listening, if they're still awake, which I'm sure they are? Peter, any last words for you about the year, etc.?
I think it's going to be a very good year for pricing from a broker perspective. I think that's the key thing. I think from a lender's perspective, it's going to be very challenging, but I think from a broker's perspective, it's going to be a very good year for products and pricing. That's the only thing I think that I'd say, to be honest.
Riz, anything from you?
I think
as a community, let's
do more to educate people about the role of a broker and what we do, and we don't just push a button. And if you're running your own business and you're selling your time, ultimately value what you do as well and communicate that with your clients. I think that's really important this year.
Emma?
Don't get consumed with what's going on around you in the media. Just crack on. You're doing a good job. 2024 is going to be a good year for all of us, and a bit of stability that's welcomed, I think, by the whole broker community. There you go.
Yes,
Amen.
love that. Brilliant. Thank you.
What about you, Monty? What about you?
Yeah, I mean, for me, it's all about. I think that I am optimistic about this year, and I think I agree with all of that. I think we need to come together as a community like never before. We need to work closely with our lender partners, and we need to make sure we are showing the general public and regulators what a really great industry and what a great job we do for the public at large, and really make sure that advice is at the forefront of everything we do. So thank you very much to my guests. Thank you, Emma. Thank you, Riz. Thank you, Peter. An article about this live will appear on the Intermediary. And also I do encourage all of you, you'd expect me to say this, to get involved with Newspage. Check it out. The more voices we have out there in the public domain, the better. Just don't take me down deliberately in the process. And yeah, if you have enjoyed this, then please leave positive comments. My name's Andrew Montlake. If you haven't enjoyed it, I've been Dominic Hyatt. Thank you very much.
Thank you.
Thank you.
See you later, guys. Take care.
Take care.